Hey there, Canadian Wealth Secret Seekers. Today we are unpacking a topic that most Canadians misunderstand and that business owners really misunderstand. Yes, that is the RRSP, and in particular, how to treat RRSPs when we're talking about meltdown strategies. So, how do we turn a tax problem into
Right.
an actual wealth building opportunity?
Right. Yeah. Like most Canadians, I think when you think about it, we roll into retirement without a plan, to withdraw from those RSPs. So, this is aside, like this is like you've been 100% convinced that you need to plug in and build that RSP fund so that when you roll it into a riff, you can start withdrawing. Like this is not like, hey, if you're a pensioner, you're not thinking about all of this. You're thinking of that as like a secondary plan. But many Canadians are like, that's the be all end all. That's the core of like our retirement strategy. And, in really the idea I think most Canadians have is plug without any thought necessarily until you get to the part where you start withdrawing. And that's where that I think misunderstanding is coming from specifically. And, if you're not thinking that way, especially business owners, then you're going to be leaving a ton of money to the CRA.
Absolutely. Absolutely. So by the end of today's episode, you're going to understand the 3 RRSP meltdown strategies and how they actually work. And most importantly, how they work with Canadian business owners so that we can integrate them into the 4 components of your healthy wealth planning system. We want your RRSP to be a tool, not a liability. So let's jump in.
Right. Right. So like, I guess in a way, your RSP meltdown strategy isn't like one strategy. You got to think of it as more of a system. And actually, I just heard James Clear, talk about this. Is that he's like, people who have goals, like the people who are obsessed with goals, are like they're obsessed with like the single success. It's like, I want success now, so I make a goal. But people who are obsessed with systems are, become obsessed with continuous goals. They're after sustainable goals, repeated wins, and that's the difference. Like this is like when you think about all these strategies here today together, that's what I want you to think about is you're building a system and not just one strategy, 2 strategies. So you're trying to design this system to get at least the least amount of tax possible, so that you can keep it in your hands and your family's hands.
For sure. And, I think it's important. And, we say it a lot on the podcast, but sometimes people don't fully process it. When you have an incorporated business, depending on the levels of income that the business is earning, what they're netting at the end of the year, and what you need to take at a personal level for your own lifestyle are going to significantly impact how many dollars we're going to funnel into different strategies. But one thing I can say is that, more and more I'm seeing a lot of clients that look at the RRSP as almost like a bad play, right? And I get it. Like at the end of the day, all the money coming out is going to get taxed. But there are huge benefits, especially in high personal income tax years, as to why we might want to consider funding the RRSP. Now, for our successful business owners, what's important to note too is that, the maximum you can put into an RRSP is 18% of your earned income or $32,000-ish per year. You can't go over that $32,000 limit. It's whichever one comes first. Is that the right language there? But 18% up to 32,000 maximum. So that's a really important piece here. When we have money in our corporation, and especially if we have a significant amount that we're retaining every year, I tend to lean towards pushing and prodding business owners to consider putting some dollars in the RRSP. Yes, it's a high security prison, we call it, compared to the low security prison that is your corporation, but it gives you some diversification of buckets. And as we strategically want to fund the RRSP, so we want to do it for maximum tax savings while we're working, we also need to be thinking ahead as to how are we going to flow those funds out in the most tax efficient manner on the way out.
Right. Yeah. Like we've said before, it's like The ultimate goal here, when you're thinking about this planning process and your financial planning process, when you have a corporation and you've got T4 income, is you want to get this money into your hands eventually. Like this is you're working like a dog. Like you're working hard to generate, financial stability, success, live the lifestyle you want through a corporation. It made sense to incorporate. You still need to get those dollars into your family's hands. And so I think that's an important kind of point to bring up, because why not, if you can take advantage of some of the thresholds like you're suggesting, and if you're earning, say, a certain level of income where it's like $30,000 is not a huge chunk of your retained earnings every year, then it makes sense to get it out of there now and get it into your personal hands to, say, invest on a personal level, and then you can use the RRSP meltdown strategies at the personal level when you're utilizing getting that money out there. So there's some benefits there. And this is one of the strategies we use personally right now, is that we pay ourselves a little more to make use of that threshold, because we don't need that to live. So we stuff the RRSP, and then we're going to make use of the meltdown strategies here.
Yeah. And specifically, if your incorporated business is earning or netting more than $1,000 per year, that means that you should be taking more than $100,000, whether you need it for lifestyle or not. You should probably take around 130. And if you're taking 130, that's now opening more room in your RSP if you're taking a salary. If you're only taking a dividend, you are foregoing the CPP, which saves a little bit of money, about $8,000 a year between you and the corporation. But it also does not open up any RRSP contribution room. I tend to think of those two things as diversification plays or opportunities. Whether you choose to use the RRSP room every single year is up to you, especially if you think that you're going to be in a higher income year that you can't control. You might want to save some of that room. For us, we tend to just look at it as a way to kind of get dollars in different places so that we have more flexibility. Because here's the reality, is that I get to pay essentially zero tax on the RRSP when I put the dollars in, and then I get to grow it tax deferred. Great. Yep. I do get taxed heavily on the way out. That's the negative. Right. In the corporation, I get to pay a small amount of tax, and I get to invest those things as long as I'm being cautious and careful about what I'm investing in inside the corporation. I get to also defer tax as long as they're capital gains. So I pay a little bit of tax, but I pay less tax on the way out. So to me, that's a diversification play in terms of where I'm investing. And of course, if I invest at a personal level, we have after-tax dollars happening. I put it in a non-registered account, but I also do get a better or more favorable tax play on the way out. So I want all three of those things happening. So making sure that in my mind, I'm not going all in or all out on any one strategy is going to be really important here. But for today, let's talk specifically about the three strategies that will help us melt down the RRSP in particular more efficiently.
Right. And then what we'll do is we'll sprinkle in specifically what that means for business owners as we talk, because you have to navigate between your business and your on the personal side, right? There's that wall between the two. So the strategies we're going to talk about, since they're meltdown strategies for the RRSP, this is going to be on the personal level, but we want to make sure that you're aware of the moves you could be making on the corporate side as well. So let's get some facts out here too, as well, is that most people, I think, like, do nothing. Like I said before, is like do nothing till like age 71, and all of a sudden it's like, now I'm forced to pull money from the RRSP, right? Like you have to convert that to a RIF at some point, and then all of a sudden now you've got these caps you got to be making sure that you're pulling. So this is why the strategies are important, is because what you don't want is to be in that time of life where you've built up so much of your this is where the business owner comes in. It's like you've built up this business to like give you a ton of money to live your lifestyle, and the goal was to have more money later than now. Like have more, like you want to continually grow, which is a different mindset, I think, than most T4 employees. So you're all of a sudden you're going to be having income from various sources and all of a sudden you've got an RRSP that you need to melt down, and you don't want to be paying the highest tax bracket at that time when you have to start pulling more money than you're forced to. And so also think about this. If you die with your RRSP still there, and you don't, let's say you don't have a spouse, let's say your spouse passes before you, then all of a sudden you've got all of that now is going to be liquidated in that tax year, and you're looking at losing 40 to 54% of that to the government and not staying in your family legacy plan.
100%, 100%. So as we do that, we want to think about how can I maximize, and this is really going to be strategy number one, is maximizing low or no income years. Now, for a typical T4 employee, like you have less control over that, right? So like maybe you got laid off. Okay, now you're in a position where maybe taking some money out of an RSP could make sense. It might actually be forced on you because maybe you don't have income coming in. As an incorporated business owner, you get to control what your income looks like from year to year. So as we get a little bit older and closer to our financial freedom years, you might choose to actually reduce the amount of income you're taking from your incorporated business and start to pull some money out of the RRSP, right? If your RRSP is getting large, or let's say you've got an RRSP that, didn't feel that large, but maybe over the last 8 or 10 years, you've seen massive growth in the markets overall. And now your RRSP is large and you're worried that, hey, this is going to be a big tax burden down the road. We certainly want to continue to grow those dollars tax deferred and essentially tax free on the growth side of things. But we also don't want that bucket to be too large so that there's a massive income tax bill to be paid at the end if we can deal with it now, right? So if we're in a low or no income tax year, we want to maximize the amount we are pulling from the RRSP. However, you do want to be aware and cognizant of those tax brackets. So, you don't want to be pulling so much that you're now in such a high tax bracket that it doesn't make a difference, right? If you're in 50% tax bracket, that's not going to be a good play. You might as well defer and pay the 50% down the road. But if we can take advantage of a low tax draw or a low tax year, that is huge. So you might choose when you turn maybe 60 to do a couple things here. If I'm 60, I'm going to defer my CPP, right? Make sure that I'm not taking CPP yet so that my CPP payments are higher and I might take a little bit more out of the RRSP. Now, you might also consider it like if you don't need these dollars, right? You might be saying, listen, Kyle, John, I don't need the money. If it's going to mean paying a smaller amount of tax on those dollars than you would in the future, it still could be beneficial to pull them out, put them into your tax-free savings account, put them into other strategies, your wealth reservoir, or maybe even consider putting them in a non-registered account to grow a capital gain, not dividends, but capital gains so that we can defer over on that bucket.
Now think about, I want you to kind of go down a thought process with me here, because it's like, if you think about, I'm a numbers guy and I want to know the numbers where my lifestyle is. Like, if you've listened long enough to this podcast, you've probably heard me say, like, we track like every percent is tracked somewhere in my life. And therefore we know, how much expenses we have every single month, every single day, every single year. I've got that data map for years of data. I use that also to project the future. Us math teachers from another life get to, experiment and make predictions and model different scenarios. So when I think about projecting into the future of knowing what numbers I need for my lifestyle and to cover my lifestyle, and think about what that looks like for withdrawal rates, I think when you think about what that withdrawal number is going to be, and then you compare it to like, how much will my RRSP, if I grow the RRSP and project that, how much will that look like at 71? And all of a sudden, am I now automatically in the 50% tax bracket in that year? I might want to start thinking about reversing engineering it and pulling more money now. As long as like you said, if I'm already in the 50% tax bracket, it's not going to matter. But you want to do a little bit of that projection. So then when you think about like the 4 phases of our healthy wealth planning system, I think about vision, I think about numbers, and I want to go like, let's just project a little bit in the future to see if all of my businesses keep doing the things they're doing. I'm going to get to this point, and is it not going to matter, or is it going to matter? And therefore, can I do something now about it? That's an important kind of mentality switch that I like to turn on.
Yeah. And to be honest, like if your RRSP, when you pass, hopefully when you're 110, but if it is over $250,000, it's likely that in combination with all the other deemed disposition things that are going to go on in your estate, you're going to be in the highest tax bracket, right? So that 50% is going to be hard to avoid. So you're not going to be able to do it perfectly. You know, we don't know exactly how much we're going to want to spend 10 years from now. But what we can do is we can at least try to get as many dollars out as efficiently as possible while we're around and while we know what we need for lifestyle. Now, for business owners, we also have this opportunity that isn't available to T4 employees, and that I can essentially be pulling some income, and we'll call it almost like your regular income, out of the RRSP, and I can consider using leverage strategies in order to make up for the difference so that I can still keep my tax bracket low while still having access to more capital at a personal level. Now, where that leverage comes from is totally up to you. One is against your primary home. So if, let's say, you have no mortgage against your primary home, you could do a reverse mortgage or use a home equity line of credit to take a little additional dollars against that home. Now, a lot of people get a little bit freaked out by that, but it is worth thinking about. The other piece is, if we've developed our wealth reservoir inside of the corporation, we now have a highly leverageable cash value life insurance policy that sits inside the corporation that can also be used for leverage. So as we approach some of these higher tax brackets, you can start using leverage for the dollars above the tax bracket rate that you do not want to creep into. So these are strategies that keep you ahead of the game. And in reality, for those successful business owners that find themselves in a position where they're going, listen, I'm maxing out my RSP every year, and I also have retained earnings every year, they are likely going to be in a place where at the time of death, they're probably going to have too much still in the RSP, because it's just not going to make sense for them to take too much out every single year along the way. But we can take out a certain amount. But the other chunk that's still left in that RRSP or left inside the corporation is now growing uninterrupted, so that you're being able to utilize more dollars while you're living and enjoying life. And you're able to leave a legacy that lasts on the back end, even if there are high taxes along the way. Because once again, if your corporate wealth reservoir tool is the insurance policy, like it is for most of our clients, that particular policy is going to be worth more when we pass than when we're living. And it is going to flow out tax-free, which can help to mitigate some of the other tax issues that may be lingering from the RRSP or other taxable investments that we've made.
And I think that, you know, those ideas and thinking about the tool and the structure that our clients are using actually rolls perfectly into the second strategy that I think we want, whether you're a T4 or whether you're a business owner, to think about, which is leverage strategies. So think about the Smith maneuver for a second, because this is like it's an easy way to think about the leverage strategy, is that the Smith maneuver it's an ongoing process that allows you to take non-tax deductible interest on your mortgage and convert that into tax deductible interest. And so when you think about that process, you know, when you use leverage for investment purposes, that interest that you now are paying, you can write that off against your income. So when you translate that thinking into your RSP strategy, you can use leverage to, you know, you go and invest in something and then use that interest to write off against any sort of meltdown strategy you're using for your RSP. Because if you're going to pull that RSP, you're thinking, well, I don't want to pay the tax on the RSP because it's tax deferred, so I got to pay it now when I start pulling it. But now you can write that off if you think about using a leverage as a strategy, which in a way falls in line with some of the moves that we make with our our business owners and the moves that we make with our high net worth and our entrepreneurs and our business and our clients in the Canadian Wealth Secrets. It's like we want to make these kind of moves to build our wealth, and a lot of times those moves involve leverage. So it's a natural move here to also allow you to write off some of that income from your RSP with meltdown strategy.
I love it. I love it. So let me kind of take what you're saying and kind of like put it together with maybe an example just to make sure it's clear, because I would argue that the Smith maneuver is something that a lot of people are doing while they're on their wealth building journey. So usually these are people like they bought a home, they actually have a mortgage on the home, and over time as they're paying down that mortgage, they're reborrowing principal on their home equity line of credit in order to make some sort of investment. At the same time, what ends up happening is they now have interest that they pay on the home equity line of credit or the investment loan, whatever it is, and they're able to write it off against other income in their world. So that's a great strategy. Now, if we kind of flip it around and you say like we're approaching these later years, we're talking RRSP meltdown strategy, it might look and sound a little different. Now, if you've been doing the Smith maneuver for your whole life, you might already have your home equity line of credit already sort of maxed out with this big investment bucket over here. But the reality is the vast majority of Canadians do not have a substantial Smith maneuver strategy in place. Right. We got lots of people researching about it, lots of people looking into it, but a lot of people are, they either just never pull the trigger, they don't feel confident to do it, or they just don't stick to it, right? And they just slowly stop doing it over time. Well, if you're going into your financial freedom years, and a lot of times people don't want to have a mortgage when they go into their financial freedom years. That means that you probably have your primary residence if you're a homeowner, and you have equity in it. And what we could do, if you want to take more money out of the RRSP, you're going to trigger a higher tax bracket for yourself. We could at the same time be pulling money against our home equity line of credit in order to make some sort of non-registered investment. And that interest now can be written off against our higher income based on that higher amount that we pulled from the RSP in that particular year. So there are ways for us to do this where you can essentially go, I'm pulling from one investment that was tax deferred. I'm now going to trigger a higher amount of tax, but because I'm going to leverage against my home, or other asset, I can write off that interest against this higher tax rate that I'm in and see my net worth actually increase in the process. So this is something just to get your wheels turning. It again is something that a lot of people don't follow through on because it is a little more complex and it does involve risk, right? Like there is leverage here. So you just have to be cautious that when we're doing something like this, that we are investing into an asset that we are comfortable and confident in. And again, I would argue that you want to make sure it's something diversified. Maybe it's global equity fund. Maybe it's, the S&P 500 ETF, like something like that. Or maybe even like a MIC. Like it could be something like they do at Erie Shores Capital here locally, where they do private leverage against or private loans for real estate. But it's a fund so that you're not doing it all in on any one particular asset. And if it goes south, that, you're there sitting with a big zero, you've got a bit of diversification to sort of take care of things for you.
Right. Okay. Let's do a quick recap before we move on to the next strategy here. We're talking about meltdown strategies. Specifically, the first one was like maximizing low or no income years and being strategic about offsetting, say, income with your meltdown strategy from RSP, and taking some of that income, but pairing it with, say, being flexible with your salary when you could have that flexibility to decide on how much to pay yourself that year. So you can play around with those numbers as a business owner who's paying yourself. Strategy number 2, we talked about leverage strategies right here. Now let's move into strategy number 3, which is really the classic, I think, meltdown strategy, which I think is like pushing off other other income until later. So deferring other income like CPP, old age security, as long as possible, so that you can then you can make use of the RSP earlier on.
Yeah, like what you'll actually see is people doing the exact opposite of putting off this other income. Like they'll take the RSP, they will not touch the RSP until they're 71, and they're forced to start taking some money through their RRIF. And I think the RIF is something, it's really interesting. It's almost like you've been so trained to be putting money into your RRSP that you almost feel like you're committing a sin if you take money out of it, especially if you take it out of it, before say 71, when in reality, you may want to be, and again, it's always a may, like we've got to look at all your financial situation, all the different assets you have, and you want to make sure that we're optimizing along the way. And typically most Canadians, especially incorporated business owners, should be reaching out to someone, a professional, could be us, could be someone else, in order to try to help them think through this, because every situation really is different. But if I push off my CPP, and now this is all very contingent on your health, right? Like if I'm 60 and I'm relatively healthy, and that means that I'm expecting to have a regular average age of life for typical Canadian male, if that's the case, pushing off your CPP as long as you are healthy is a good move, because you're going to get more CPP by doing so. And it's pushing off income so that we can take advantage of taking some of the dollars out of our RRSP. Now, at the same time, inside your corporate bubble, you're going to have other investments in there. Hopefully, you're going to have a bucket of other investments. Maybe it's rental properties like us. Maybe it's a stock portfolio like we also have. You may want to start realizing some capital gains from that bucket as well. This isn't an either or. It's how do we melt these things down as efficiently as possible, right?
It's a system, right?
A system, exactly. So we want to make sure that we've got a full system going here, and we want to make sure that we're considering all of the assets so that we can slowly melt down from the buckets that make the most sense. So if we can shove off other income by, let's say, not taking that salary anymore from my company or my dividends from my corporation or my holding company, we can actually start to drain other buckets a little bit more easily. Now, as a business owner, you're going to also have to keep track of these accounts that have credits, some of these notional accounts, such as the capital dividend account. Are there any capital dividends available to you? They come out to you tax-free. That could be on past capital gains sales that you've had. Maybe you sold a property in the past and you never took advantage of that capital gain tax exemption that you're able to take out. Maybe you've got a credit in your refundable dividend tax on hand account. That is essentially the amount of money that can get rebated back to you. I say rebated, refunded back to you based on the punitive passive income taxes that your corporation may have been paying in the past. You can take advantage of some of these things along the way. So it also means that you have a more complex meltdown strategy and picture that you need to be cognizant and aware of as an incorporated business owner who may also have an RRSP sitting there, so that we can try to do this as efficiently as possible so you have as many dollars as possible for you to spend. Your net worth stays as high as possible during your lifetime, and your estate has a legacy that lasts because you didn't get hammered in taxes throughout your lifetime and, of course, after your passing.
All right. So we talked about 3 strategies for RSP meltdown because we want to make sure that we're maximizing our income but minimizing our tax. And that's the big idea for me here, is to be almost like, imagine that you've got one of those old stereos so that you have these dials, right? It's like I can move this one up, but I move this one down. It's like I move that one over, like this one up. It's like these dials that you want to consistently move. Like that's how they work as a system, so that I'm trying to find the right balance each year. And it's going to look different from year to year, but the whole point is to think about the future and being able to make sense or make use of some of these credits, but also these strategies now or coming up, so that we pay less tax overall. So that last strategy here was specifically, thinking about the income sources and then maybe delaying some income sources. Now, the second strategy we talked about was using leverage and making use of leverage and the tax that taxes are, say, created, or some of the interest that's created there. And then the first strategy we talked about is specifically, making use of low income years or being strategic with your income to make use of these strategies. I'm going to give you one bonus here that's your homework. One bonus here that's your homework is that I want you to go and read the book Die with Zero. Because Die with Zero can be a great also mental strategy exercise for you to think about, like, I have a bunch of money now, and how can I gift some of it away, or how can I use it now so that when I die with zero, and therefore no money is going to go to the CRA. So that's some homework for you in thinking about meltdown strategies.
I love it. I love it. So the main goal here is, like, unlike most T4 employees, they often only have 3 buckets to really worry about, right? They've got maybe a pension or RSP or both. They've got the tax-free savings account, and then they've got CPP and OAS that are kind of, grouped together here. Whereas business owners, like the folks that are listening to this, John, you and I, you often have also layered on top corporate retained earnings. You've got non-registered portfolios, maybe a holding company, maybe a family trust. We're going to talk more about trusts on a future episode as well. Hopefully you've got a corporate owned whole life insurance policy if you have those retained earnings, maybe real estate, and maybe some other buckets as well, different types of private investments. So the RRSP is not the centerpiece of your wealth system, but we want to make sure that it is a part of your wealth system and that we design that system effectively and efficiently, both as we fund it on the way up and as we slowly melt down over the rest of your life. Let's keep more of those dollars in your personal pocket and less out of the CRAs. And finally, make sure that you're leaving that legacy that lasts for your estate. So if you want to hop on a call, you should head on over to CanadianWealthSecrets.com/discovery. We'll walk you through those different buckets. We'll analyze your situation and really come up with a plan and educate you on that plan so that you understand what you're up against and what decisions are right for you in order for you to have that complete whole financial system that you're after. If you haven't yet, you can head over and take our assessment over at CanadianWealthSecrets.com/pathways. And finally, for those incorporated business owners, you should be hopping into our masterclass over at CanadianWealthSecrets.com/masterclass.
Just a reminder, the content you heard here today is for informational purposes only. Should not consider any such information as material, legal, or tax, or investment, or financial advice. Kyle Pierce is a licensed life and accident and sickness insurance agent and the president of corporate wealth management here at Canadian Wealth Secrets.